Hi, David Bassanese here, Chief Economist at BetaShares, and this is a snapshot of my market trends report for the month of September. And really, looking back over the previous month, it's been a sea of red in global equity markets. The MSCI All Country World Index down 8.4% in the month. The ASX down 6.2%, so not as much, but still a reasonably significant decline in our market. What was the key driver? Well, interest rates, unfortunately, surged higher again over the course of the month on the back of some continued high inflation readings, particularly in the United States, and continued aggressive talk from the US Federal Reserve about raising interest rates. So we had US 10-year bond yields actually go up 0.64% up to 3.83%. Australian bond yields went up not as much, about 0.29% up to 3.89. So what we have seen is the spread, or the interest rate spread between Australian and US bonds narrowing. So our bond market is not selling off at the moment as aggressively as the US. And I think that's because the market here is starting to come around to the view that the Reserve Bank won't need to raise interest rates as aggressively as the United States over the coming year. Nonetheless, it was a period of weakness for equity markets, and as you would expect, it was the more interest rate sensitive sectors of the market that were hurt particularly hard in September. Things like infrastructure and property and also technology continuing to remain under pressure. So what's the outlook? I mean, it's still a pretty difficult outlook for the equity market. We still have persistently high inflation. I mean, inflation has peaked. It is coming off, but at this point, it doesn't seem like it's coming off quickly enough to cause central banks to drop their aggressive tone with regard to interest rates. So we are looking at the US progressively slowing. I suspect that's going to continue to hurt the earnings outlook. So I think equities should remain somewhat under pressure, I think, over coming months. Though we are, again, I think maybe getting close to the peak in terms of bond yields, because as central banks raise rates, we're getting closer and closer to the point where that will start to slow growth, start to bring down inflation. And as a result, central banks won't need to progressively revise up the extent to which they will be lifting rates. So we're closer to the end of the worst, I think, in terms of the bond market, but probably not yet for the equity market. That's it for now. Thanks for watching, and I'll catch you again next month.